I'm Kevin McCaffrey, founder of Private Markets Insider. I welcome our community and Ravi Ugale, Managing Director with Star Mountain Capital, for this episode of PMI Insights. Ravi, say hello to the audience.
Hello, Kevin. Thanks for having me.
My pleasure. Yeah, so we're excited to talk with Mr. Ugale about his white paper, available through the website linked to the QR code on screen and show notes, for the rise of private credit secondaries. Ravi will also be speaking on our secondaries panel at the Alternative Investment and Deal Connect Summit in Atlanta on March 27th. In the new year, which is fast approaching. For those new to the platform, Private Markets Insider is a specialized network that pulls together content and thought leaders like you, Ravi. PMI helps investors and business owners build valuable relationships and market intel. Ravi, I'm aware you have 30 plus years of experience beyond just private credit and secondaries, also private equity, venture capital, investment banking, business operations. When we met over a decade ago, you were leading private capital solutions for GenSpring family offices, and you also had a role as head of private capital manager research for Truist, I believe, and all that fit nicely with my efforts to build the Partner Connect events platform for Thomson Reuters, connecting you and other investors with fund managers and deal sources. So now you have a valued perspective, given your experience with due diligence, manager selection, portfolio allocation, and construction for a range of different client types. So how did you come to focus on private credit secondaries in the lower middle market, in particular with Star Mountain?
Yeah, thanks for having me first, Kevin, and thanks for the kind introduction. I've always had a passion for both private market secondaries as well as investing in the lower middle market, which, as you know, drives approximately 50% of the US GDP. In my prior role as a general partner for 10 years, I focused on growth companies in the lower middle market, gaining valuable insights and experience, and really enjoyed adding value to these companies to fuel their growth as a board member with operating experience. Also, in my prior role as an LP allocator, as you mentioned, for over 12 years, I believed in private market secondary strategies from the get-go for several reasons, including no blind pool risk, J-curve mitigation, instant diversification across vintage years, faster velocity of cash flows, and opportunity for higher returns on a risk-adjusted basis. During my LP tenure, we reviewed many secondary fund managers across private capital strategies each year and onboarded 1 to 2 secondary funds every year. This passion and experience in secondaries and the lower middle market led me to becoming part of the growing secondaries platform at Star Mountain, where I'm focused on origination, underwriting, portfolio management, and monitoring, as well as being on the investment committee of our private credit secondary funds.
That's great. Yeah, thank you for that background. And let's get into talking about your paper. I look at this market as the merging of growing opportunities in private credit and secondaries. Sources put private credit markets at 2 to 3 trillion. JP Morgan's on the high end, but either way, it's grown over 10 times since the great financial crisis, when banks dropped out of traditional lending roles, and there's no end in sight from what I can see. And meanwhile, secondaries markets have become more popular and fluid, just as we saw over the past 20 years or so in private equity, and the private credit secondaries market is growing quickly. So how do we get here? What's the opportunity?
Yeah, great question, Kevin. So the private credit market has experienced substantial growth in recent years, as you pointed out. It was really fueled by the rise of the non-bank lending after the global financial crisis. As a result of this, the universe of investable private credit assets has expanded significantly, providing ample opportunities for secondary transactions. Also, as traditional fixed income yields became volatile and remain volatile, investors increasingly turn to private credit strategies to enhance portfolio returns and diversification. Private credit, including private credit secondaries, offers access to a wide range of credit assets with potentially higher yields and lower correlation to traditional equity and fixed income markets. According to a recent survey by placement and advisory specialist Eli Place Partners, 30 billion of deal flow is predicted for 2024 in private credit secondary space and reaching 50 billion of volume as early as 2026. So you can see there's significant growth expected. And also, it's expected that the private credit market will continue to grow given increased bank regulation and demographic trends with aging business owners looking for transition capital. So the private credit market, as you mentioned, currently at 3 trillion, even if 2% of that was to come to the market in terms of needs for liquidity in line with private equity secondaries, that would mean the private credit secondary markets would grow by significant multiples. So we are very excited about the space and the opportunity.
Great. Yeah, that makes sense. And with more interest in secondaries markets than ever, and the relatively recent attention to private credit secondaries, why are investors taking notice? How are they using secondaries to diversify and manage risk?
Yeah, so in the private credit secondary markets, it really presents a significant opportunity for investors seeking exposure to the private credit asset class. Investors in private credit secondaries may seek to achieve several objectives, including portfolio diversification, yield enhancement, J-curve mitigation, as well as liquidity management. By acquiring existing credit assets through a secondary fund offering, investors can gain exposure to a wide range of credit opportunities across multiple vintage years, potentially generating attractive risk-adjusted returns while mitigating some of the liquidity and duration risk associated with traditional fixed income investments.
So since I'm catering to others that want something others may not see, how do you think about market inefficiencies around private credit secondaries and underlying asymmetry in info and returns?
Yeah, so private credit secondaries market is really characterized by, as you mentioned, information asymmetry and limited liquidity, creating opportunities for skilled investors to capitalize on these market inefficiencies and mispricing. So what is needed is really active management, rigorous due diligence, and specialized expertise, which are critical for not only identifying but also unlocking value in these private credit secondary transactions. Within private credit secondary transactions, there are a multitude of risks a manager needs to be aware of and evaluate when determining whether a position is worth the price. So investing in secondary sales requires a thorough examination of these various risks. One of the primary questions fund managers should be asking is why the current owner is selling the asset. So by implementing a proper risk management and vetting process, teams can analyze insights into potential underlying issues with the investment pool of assets. Additionally, it is crucial to determine if the asset in question is challenged that can affect the position's value. So evaluating the portfolio's valuation is an essential step in assessing whether the assets are valued prudently. And the risk levels associated with the positions also need to include vetting firm-specific risks. This can include proper firm and incentive alignment, which can significantly impact the management and performance of the assets. And lastly, understanding fund level leverage and leverage per unit of risk is crucial in determining a proper valuation for an LP fund interest.
Absolutely. And, in the midst of thinking about all these factors, and I know you've looked at this as an allocator over the decades as well, how important is team in evaluating risk, leverage, structure, and valuation involved in these opportunities?
Yeah, we believe that to properly address these areas, investment firms need highly experienced, well resourced, and strategically aligned teams to review opportunities. These teams need to analyze opportunities to assess fair market value and growth potential, as well as determining whether they are high quality assets. It's also difficult for a lender to force a disposition of assets within a fund, which is a risk that investors need to evaluate and understand, as this could affect the exit time frames and therefore impact the overall internal rate of return performance. So, by meticulously examining these factors, a firm can mitigate these risks and enhance the likelihood of profitable investments in the secondary market.
Right. That's crucial. Well, look, this is all very helpful, and I know a lot of these points are spelled out even better in your white paper, so thank you for that. And are there any key points from an investor allocator perspective that you'd like to make in conclusion?
Yeah, sure. I think investors like the risk return proposition that's offered by private credit secondaries, providing significantly more immediate diversification than investors would get by committing to several direct lending funds, which is how most investors gain exposure to private credit. So investors today are really focused on manager selection and credit risk. Private credit secondaries generally provides diversification across a diverse array of managers and vintages, which is particularly interesting for those also just coming into the asset class. So overall, we believe that the private credit secondary market offers investors potentially compelling opportunity to access a diverse universe of credit assets, generate attractive risk-adjusted returns, and enhance portfolio diversification in an evolving investment landscape. This can be even more pronounced in the smaller end of the private credit secondaries market, where limited buyers exist today with the origination capabilities, due diligence skills, and the strategic focus to acquire smaller credit-oriented secondary assets, thereby creating higher barriers to entry and opportunity for specialized lower middle market private credit secondary managers to benefit from this supply demand imbalance.
Yeah, that's a great point, and an important distinction I think is sometimes lost. But I welcome the audience to feel free to download the white paper by Star Mountain Capital, available through the website, linked to the QR code on screen and show notes for the rise of private credit secondaries. And register to hear updated insights from Ravi on the secondaries panel at the Alternative Investment and Deal Connect Summit in Atlanta on March 27th. And thank you for all tuning in, and happy holidays.
Thank you.